control panel, go ahead and type your question or concern, and we will get that answered for you. So why don't we go ahead and jump right into this. As mentioned, this is good for those folks that are on the phone, that are CES. We welcome you, and this will be good for an hour of CES credit, which we will report to the folks that stay on for the entire webinar to the FEA so that you can get your credit. So again, welcome. I'm looking at the attendee list. We've got a number of folks here that we've done business with, and good to see you. And I see some new faces here. So welcome to all of you. I think we've got something here that that everyone on the phone here is going to appreciate and find to add to your business. So structured sales, advanced concepts. Before we get into that, we just wanted to give a quick hello and introduce ourselves to you. This is pretty much our executive team. And as mentioned, my name is Chris Princess. I work on the operations side for sales and marketing. And I'm also going to be joined by two of my colleagues, Brian Michaels, who, as many of you know, is our general counsel and well known here in the industry. So happy to have him as a colleague and to join our webinar today. And then Joe Papel, who is our CFO and an acting CPA. He's going to cover some of the client deliverables that we will provide to our mutual clients and go through some of that detail. And we'll move quickly through this. This is pretty much our mission statement, and a lot of you are familiar with this because we do provide this in our marketing packets and our materials. But really the thing to pay attention to here is really the people and the staff that we have on board here working with your clients that we've already worked with and the folks that we're going to be working with soon. Their clients, we do have a staff that really I'm proud to be a part of and knows their stuff and what they're doing with clients. Now, at the end of the CES portion of the presentation, we're going to spend a few minutes here on an opportunity that we're going to roll out to all the folks here on the webinar for a way for us to begin working together successfully in a way to get your current channel partners involved. So I think you'll be excited about what we're going to roll out. So if everyone can hold tight at the end, we'll make a mention to that. So anyways, going forward, and I know a lot of you have had technical problems with signing on to the GoToWebinar because of your firewalls. I sent you the presentation, and I will make note as best we can when we are flipping to the next page. So today's agenda, let's go through this. A structured sale preview, which is really our core strategy and the product we're going to be discussing. Just a quick capital gains review, just to make sure we're all on the same page. And then, of course, the core revenue code that the structured sale is based on, which is installment sale or IRC 453. The nuts and bolts of a structured sale, getting into some of the legal justifications. Our quote-unquote claim to fame, the 1031 fallback. Some case analysis, mostly by Joe, but where there's been success stories and where you can immediately begin implementing our strategy and our product to build your business and to help your clients. And a couple of new ideas that we cannot take credit for, but have come up either through our partners or through our clients or through our clients' advisors, but that we're here to share with all for the good of all. So with that said, let's move right along. Now, this question is one that has really no one answer. What's wrong with receiving a large lump sum of cash? And the main answer is there's not a darn thing. But there are some issues with that, and that's why pretty much all of us on the phone here have a career that we enjoy thoroughly, and that is this guy, Uncle Sam. Of course, the tax man cometh. Now, what's the opportunity to alleviate those consequences? So a taxpayer is selling a property for capital gain. What are the options for a taxpayer? Pretty basic stuff here. Well, you know, as all of us on the phone know, of course, the 1031 exchange. A godsend from our government, and still just the most basic core way to defer your taxes and build wealth, bar none. But let's take that a step further. Okay, so we've got the exchange, but now what if the taxpayer can't exchange? And let's look at some of these situations. So when someone talks to you about exchanging, I'm sure a lot of you have witnessed this problem. Primary residence, you can't exchange, what can you do? Vacation property, what's your typical answer? Well, we can't do much. I'm sure a lot of you have run into folks that are selling their business. So goodwill, or maybe there's a private stock or partnership ownership sold. Now, what are the options there? What if the exchange should fail, either in full or in part, where there's some equity boot, where the napkin rule comes into play? Leading up to, where do you use a structured sale? And again, we'll get into all this. Now, we want to be sensitive here because a lot of the folks here on the phone are intermediaries, and we completely understand. For the folks that are not intermediaries, where you're maybe working with an intermediary or an exchange to get your client into another exchange, great. We are very sensitive to the fact that that is your core business. And all we're here to do, as many of you know, is we are here to work side by side with you to enhance that. Again, giving a strategy or an option to where a taxpayer can't exchange because that property is not eligible for a 1031. As mentioned, where there's a failed exchange, or other related opportunities, which we will get into going forward, maybe where an exchange doesn't make sense for an exit strategy. And again, some of the benefits from all sides here of offering what we're going to be discussing to your clients, of course, is a strategy that up until this point I know a lot of you may not be familiar with or even knew existed. And from when we've been out in the field here and I've traveled the country, a lot of these clients are like, where have you guys been? So it's been well accepted. For you, of course, in the eyes of your clients, furthering the consulting work you're doing with them, giving you a competitive advantage with our partnership. And as a number of you know, the additional revenue from the structured sale. There's a commission involved with our partnership. The fallback with of course, saving the failed exchange. And this is something that has come out from our partnerships with intermediaries and with different real estate professionals, is getting additional exchanges because of our partnership. We've seen a huge increase in clients staying from the 45th day to the 180th day, which I know to you intermediary folks is not a bad thing, and of course in the exit strategy. So moving right along, we are on the page named Capital Gain Review with an installment sale overview, and I am going to go ahead and hand the ball off to my colleague Brian Michaels.
Good morning. I am going to launch right in here with a review of capital gains and installment sale, or installment method of reporting gains, and then go into the structured sale and the fallback. As soon as I figure out, there we go. So let's start out very, very basic. What's a taxable gain? You know, obviously it's what you sell something for, subtract out what your cost or basis was or is, and that's the gain on the sale of what you pay of what you pay tax on. And then that gain can be made up of you know, different components, but basically that's it. So what's a capital asset that could be sold to qualify for capital gain treatment? That's basically stock, investment real estate, bonds, mutual funds, partnership interests, and collectibles. And there are three rates that capital gains are subject to, and most people just kind of default and say, well, it's a 15% rate, 15% long-term rate. There's actually a 25% rate that for what we do and what you do, as you know, can figure in pretty importantly. And that's a rate for the real property that was subject to depreciation, and it's the portion of the gain that represents the depreciation that was previously taken, and that's taxed at 25%. And I should say here there's a little bit of confusion sometimes because people will call this depreciation recapture, and you know, we'll get comments that you can't use installment method with depreciation recapture, which is taxed at ordinary rates, which is entirely true. But there's a very clear distinction needs to be made between this the taxation, the 25% tax rate on the depreciation versus the depreciation recapture, and a lot of times those terms are used interchangeably, and they shouldn't be. But the depreciation recapture is really, as you can see on there, accelerated depreciation in excess of the straight line depreciation, and that's what we're not talking about. So then you have a 15% capital gain rate. It's the top rate held for more than 1 year, and it's effective right now. The way the tax law is in effect through 2010, and it applies to taxpayers who have a marginal tax bracket greater than 15%, and you can see there that would be married taxable income exceeding 65.1. But here's an important thing: that actually translates to an AGI of about 90,000 for a married couple who have 2 children, and that you'll see the importance of that in the next slide. But the way the tax law is right now, it's scheduled to spring back at 20% in 2011. Then this year and next year, there's a 0% capital gain rate, and this is for taxpayers who are in bracket of 15% or lower, and that would be that AGI of 90,000 or less for a married with 2 children. So you can see some planning opportunities that are out there for people who fit into a kind of a narrow niche of, you could actually structure payments depending upon the makeup of their income, of where they could shelter $180,000, theoretically $180,000 gain over these 2 years, not pay any tax on it. Now remember, that's the gain portion of it. So the payments depend upon what the proportion is of the payments that they receive. The installment payments that they actually receive are to the total sales price would obviously be more than the 90,000. So that's one of the things that we take a look at when we're working with people, and Joe, who will be talking a little bit later, takes a pretty close look at. So anyhow, when we're talking to people, and when you are, I know that you all do this, the actual rate, when we're talking about capital gains, is really almost always more than 15%. And the reason is you have the 25% rate for that depreciation, alternative minimum tax that kicks in at a level on a lot of these. You have a phase out of personal exemptions, phase out of itemized deductions, and state income taxes. You have states like California, Montana, Minnesota, who are up in the 8 to 10% range. Adds a lot on there. So the client says they're not concerned about capital gains. We actually work through the transaction with them and take a look at does deferral make sense. So let's jump into installment sales and do a little background on this. Well, installment sale is Code Section 453, and it applies where there's and this is important, a disposition of property, and there's at least one payment received in a tax year after the year of sale. That's what it takes to qualify. And from there, the income on that installment sale is taxed under the installment method. That multi-year sale is prorated, and the gains recognized over the years and when you actually receive the payments. So if you receive cash in a year, whatever the proportion of gain is to the total tax that there is, that's what you recognized in that year. I have a couple of quick examples here just to show, and these are very, very simple examples, but let's take a look at a case where a capital gain asset sold for cash in 2009 versus sold under the installment method over 5 years. Well, here we have a sales price of $400,000. Assume there's a tax basis of $300,000, so a gross profit of $100,000. That would be taxed at a 15% rate in this year, $15,000. Now, assume that that's paid over, that $400,000 is paid over 5 years, so you get $80,000 a year. The gross profit percentage, or the gross profit, is still $100,000, but it's spread out over 5 years, so it's recognized $20,000 per year. You can see in 2009, 2010, that would actually fit into the 0% rate, and then in 2011 springs back to 10%, and the actual tax would be 2,000, 2,000, 2,000. So the sorry about that. The difference is you're paying $15,000 in tax up front versus, if you sell it for all cash this year versus $6,000, and you're not even paying that $6,000 until it starts 3 years down the road. And again, that's a simplified example, but very illustrative. So what are the benefits of this installment sale or the installment method? Well, this is what we've been talking about. You defer the payment of your capital gains taxes. You can, and here I probably used the wrong terminology, but you defer the taxation on the payment of that 25%. You can create a stream of income, which could be good for financial planning and estate planning purposes. And you can use this to convert unproductive property into a tax-deferred interest-earning investment. The disadvantages or risks of a traditional installment sale is, obviously foreclosure risk, that the buyer might not pay, and you'd have to foreclose on the property and get the property back. And typically in that situation, there's as you see in number 3, there's a diminution in the value of the property. Somebody's not paying; they're usually not taking care of it. Also, number 2, there, early payoff. The buyer, the person paying you, might sell the property early, pay you off, and that might not fit into your tax situation, and you might not have it, and you don't have any control over that. Also, there's a lack of liquidity of the underlying notes, and which is pretty common. But the structured sale, which we're going to talk about, can eliminate these disadvantages, or a lot of them. So let's dive right into this, into the structured sale, and I'll go into what it is, how it works, and the legal background of it, and then we'll flow into the fallback from there. But a structured sale, basically what it allows the seller to do is to receive a fixed income. It's guaranteed by a Fortune 50 company, and all the while deferring the capital gains. And the benefits of this are that the taxation to the seller, as we just talked about, the gains are only taxable as you actually receive them. And this is very important. There's no ongoing relationship between the buyer and seller, like there is in a traditional installment sale. So the transaction's done, buyer and seller walk away from each other. Buyer gets property, seller gets installment treatments. Arguably, there's enhanced security because the receiving those payments, the periodic payments, is not dependent on that seller. On the buyer. It's dependent upon the insurance company. Which we'll see in just a moment here. So how does this work? In a cash sale, you have a seller and a buyer. Buyer pays cash to the seller. Seller transfers property to the buyer, and the taxation is triggered at that point. With an installment sale, still have a buyer, still have a seller, but the buyer transfers cash, maybe, maybe not, but a promise of future periodic payments, a note. In return for the property. There we go. And now, the structured sale, this is how it works. This is what we already had, and now the buyer, instead of paying the cash or all of the cash to the seller, actually assigns its liability to make these future periodic payments to an assignment company. And they transfer that liability, the future liability, and the cash to the assignment company. The assignment company then uses that cash to buy an institutional funding agreement from the life insurance company, and what we're talking about here is Allstate. Well, that's what it says right up there. And this assignment company is Allstate International Assignments Limited, which is an affiliated company of Allstate. So that's how the assignment works. So now, instead of the buyer owing these future periodic payments to the seller, the assignment company owes them. And this closes the loop. And then the life insurance company, Allstate, actually makes those future periodic payments to the seller. And in addition, Allstate guarantees the performance of the assignment company. So that's how it works. Now the payment stream, because what actually happens is the buyer and seller negotiate for cash, and then we work with the seller with their tax situation, their financial situation, to turn that lump sum or portion of the lump sum into the periodic payments. And those payments can be tailor-made. They can be monthly, annually, periodic lump sums, any sort of combination. Period certain. There's no restriction on the payment streams. They're custom-made to match the seller's needs. And the payments can be structured. You can see there to keep the taxpayer out of the AMT and out of a higher tax bracket. That's what I was talking about. We worked on a couple, 2 or 3 cases just in the last month or two with the 0% tax rate of fitting payments into those rates. So there are situations out there. And then the funds that are typically in a cash sale loss of taxation are instead put to work for tax-deferred growth. And how does this work? Well, we just saw the schematic, but the sales agreement actually includes, this is the purchase agreement, actually includes language allowing for the structured sale and setting out periodic payments. Then when the sale is consummated, the periodic payments are assigned to Allstate. That payment's funded, just as the schematic showed us, by purchasing that funding agreement, and then Allstate guarantees it. So what about the legal foundation of how this actually works? We're going to take a look at the tax basics, why installment reporting works, and then the applicable tax doctrines, which we need to take a look at whether or not doing this is a disposition for 453 purposes, and then take a look at constructive receipt, which you all are familiar with in the 1031 business, and the related doctrines of cash equivalency and economic benefit. And then also we'll talk about a PLR that was issued towards the end of last year that's fairly close to being on point of this whole thing. But what we're talking about here is the same with 1031. It's founded in Code Section 453, which has been around since the 1920s, our predecessor. It's tax deferral, not tax avoidance, and the power of that is that it's coupled with the advantages of compounding. And this really is a solid choice. The reason I put this in here to consider when to create a secure fixed base of tax deferred income within any sound financial or estate plan. And the point of that is this isn't an all or nothing thing. Is that this can be custom made, custom tailored to fit the specific situation of the taxpayer. So if they have a need for a certain level of fixed guaranteed income, this is a great way to establish that with on a tax deferred basis. So for installment reporting purposes, a couple of quick slides on that. This is the buyer's debt. It's not payable on demand. It's not readily tradable. And the periodic payments aren't paid in the year of sale. So that qualifies this under 453, and you can see this Caldwell case also, which talks about it, right? Payments received, at least one payment received in the tax year other than the current tax year, and it has to be the buyer's debt, which it is. The buyer is the one, and you're going to hear this as we go through this a few more times, but the buyer actually assigns the obligation. It's not the seller. The seller's not a party to the assignment. And the seller, very, very important, has no rights in the funding agreement. The seller is a beneficiary and the sole beneficiary of the payments, but doesn't have any rights in the agreement. So under the tax doctrines, let's take a look at the disposition rules and then the constructor receipt, cash equivalency, economic benefit. Well, for 453 purposes, the installment benefits are lost if and the gain or loss has to be recognized if the installment obligation is disposed of. And that also includes deemed dispositions, and that means where the terms of the agreement are substantially changed. There are a couple of revenue rulings on point with the 75-457 and then 82-122 amplified 457. And the assignment that we use, that Allstate developed, actually kind of follows the procedures that were laid out in these revenue rulings that allow for the substitution of obligors, and that substitution is not right. The buyer is the obligor, so the substitution of that obligor is not a disposition for 453 purposes. This revenue ruling 75-457 was a case where there was a sale of real estate for a note, and then a year later the property was sold. There was a new buyer, and the seller actually agreed to substitute the new buyer as obligor under the existing note. Other terms weren't changed. The IRS said that the substitution of this new obligor didn't trigger a disposition of the note. And why is that? It's because the rights of the seller, the rights of the seller who's receiving the payments under the notes wasn't changed. They're still receiving. The change in the obligor didn't change when those payments are being received. There are a couple of cases on point too. You can see here the Wynn case and the Cunningham case, which both said there's no disposition, which stand for no disposition in a structured sale. And what the courts took a look at was whether a new note was sufficiently different to cause a disposition. Well, let's take a look at Cunningham. Here you had a company bought the stock of another company for cash and notes. The stock was pledged. A couple of years later, the company sold the stock. The new buyer agreed to assume the liability under the previous promissory notes, well, what we've just heard before. The original buyers then released from further liability, and then the new buyer and the seller actually agreed to alter the terms of the note. They changed the due dates for payment, waiver of interest, and there were substantial modifications. And the IRS argued there was a disposition of the promissory notes, which would then trigger the installment gain, but the court held that there was no acceleration, which is a good thing. These cases confirm, and this is from Revenue Ruling 75-457, the mere substitution and release of the original obligor and an installment obligation, the assumption of the installment obligation by a new obligor, without any other changes, will not in itself constitute a satisfaction or disposition under 453. That's what we're talking about. There was also a TAM, a technical advice memorandum from the cases and the revenue rulings that we've been talking about, and I hear this sometimes that, oh, the cases are old, the revenue rulings are old. Well, for tax lawyers and the lawyers here on the call, you know that seasoned cases are good. That's why a lot of the Supreme Court rulings from many, many years ago are precedent-setting and are still good. But technical advice memorandums, field service advices are where guidance has been sought from the home office, so to speak. And you can see in 92 and again in 01, they were asked this question and came back positive. Also, in the preamble to the regulations under 101, there was, you can see, a discussion of whether or not the a modification of a debt instrument triggers a disposition for purposes of 453, and what they said there was that even if it is a modification that would would cause a disposition under 101, it's not determinative for 453 purposes. In other words, 453 controls, which is very important, because sometimes, you know, people will take a look at this and say, but it's a disposition under 101, but that's not determinative, right? 453 is what's determinative. Okay, what about constructive receipt? I'm not going to spend a lot of time on this. You guys are all you know, very familiar with constructive receipt, the language in your exchange documents. So you know the language in the assignment and the language for the structured sale is as restrictive as the exchange documents to not allow for constructive receipt or actual receipt to apply. But, you know, under 451, income constructively received if it's credited to a taxpayer's account, set apart for them, otherwise made available to the taxpayer. And basically the taxpayer's control needs to be subject to substantial limitations or restrictions, which the language always provides for. And kind of the overriding theory of this is that it prohibits taxpayers from deliberately turning their backs on income and selecting the year in which they want to receive it. That's a very important point, is that this isn't that what's determinative for 453 purposes is the consummation of the economic event, which is selling or disposing of the property. How it's structured, you know, up to that point is not really determinative. It doesn't matter if the buyer could have paid cash, wanted to pay cash, and the seller said, no, I will only take installment payments. What's determinative is the actual transaction. For people who are interested about tax things, there's actually a revenue ruling. It's kind of interesting. It's only a couple pages long. It's 73-396. I just have to know this off the top of my head. That was exactly that question, where a buyer wanted to pay cash, had the cash, but the seller would only take payments, and the question was, do they qualify for installment treatment? And the IRS said yes, because, you know, obviously it is. It's the transaction, so I won't belabor that anymore. Here, there's no constructive receipt of what I just talked about, and here, again, the taxpayer, or the seller, the taxpayer, has a right to receive payments. They don't. The payments aren't credited to their account. They're not set apart. They're not otherwise made available. None of those. There's no constructive receipt, and I'll delve into that a little bit more here. So what about cash equivalency? Cash equivalency is a tax doctrine which basically says that if you have a promise to pay a benefit to an individual and it's unconditional and it's exchangeable for cash, that promise is actually the same as cash, and it's going to be currently taxable because really it can be reduced to cash. The leading case in cash equivalency is Cowden versus Commissioner from 1961. I won't go into that, but you can see the three factors there: the unconditional, assignable, promise to pay. It's the kind frequently transferred to lenders. Then the obligation was readily convertible to cash. Well, here with the structured sale, and again, you're going to hear this a couple of times, and you've already heard it, the seller can't convert the funding agreement into cash. They don't have any rights to it. The seller's not a party to the transaction between the buyer and the assignment company. The buyer and the assignment company are the two parties involved in the assignment. The documents forbid the seller from, and this is what you're used to with the, you know, the language in the exchange agreements, forbid the seller from transferring, assigning, seller, or selling, or encumbering the rights to those future payments, and any attempt by a seller to sell, transfer, or assign those rights is void. So you can see the cash equivalency doctrine doesn't apply. It's another cite to a case, Johnson versus Commissioner from 1950. Again, the installment sale method goes back to the 20s. Economic benefit. Well, the economic benefit doctrine says that there's an economic benefit when money or property is not available, so that the taxpayer can't obtain it at any time, but has been transferred to an arrangement such as a trust for the sole economic benefit of the taxpayer. To make that easier to understand is that it would be an arrangement that, but for the passage of time, the taxpayer is going to get the money. Kind of the classic case is an escrow account set up at a bank, funded by CDs that mature at, laddered CDs, that all that you have to wait for, all the taxpayer has to wait for, is the CDs to mature before they get the money. Here's the revenue ruling from 1960 talking about it, that just as a little bit of background. The leading case was Sproul versus Commissioner from 1951, but here there was economic benefit, but there was a trust set up, but the payments were vested and secured, and the taxpayer was free to assign or alienate the trust proceeds. And that's the key right. And again, in the structured sale, the seller's not a party to the transaction between the assignment company and the buyer, and the seller doesn't have any rights in the institutional funding agreement. They're a beneficiary of the payments, but they don't have any rights. They can't sell it, can't reduce it to cash, any of that sort of thing. And the funds that here's a key point, the funds that the assignment company hold, which are invested in that funding agreement, are subject to the general creditors of the assignment company. Now, the added layer of security to that is that Allstate Life then guarantees the performance of the assignment company. So, again, the seller's not a party, no rights, and the economic benefit doctrine doesn't apply. Here's this PLR. There's the site from September 2008. And what we have is, remember the structure that we just talked about is, this was with Allstate, so it's the same structure. And I'll start with the conclusion that the service concluded the taxpayer wasn't an actual or constructive receipt of periodic payments under that structure. This was an employment law case, cash basis taxpayer suing their employer for wage hostile employment practices. Now, part of the settlement was cash and future payments, and the settlement agreement allowed the employer, who's going to be paying the employee the settlement, future periodic payments. Here's what it was. This should look exactly like what we just saw, except instead of seller and buyer, it's defendant and claimant. Same thing. So the IRS took a look at 451, constructive receipt, and said that because of the way it was structured, all the reasons that we've already talked about, it doesn't apply. And also there's no economic benefit because the plaintiff ultimately winds up with a different obligor, someone other than the defendant, yet that hardly spells an economic benefit. Yeah. So that goes through why we do that. So here we are at the fallback. What is the fallback? Well, we're building off of everything that we've already just talked about. Here, the exchanger currently has an exchange with an intermediary, and the exchanger fails to identify replacement property by day 45, or doesn't close on a replacement property before day 180, or has boot, right? And the exchanger still wants to receive beneficial tax treatment for the transaction. So what we do is, prior to the termination of the exchange, the exchanger gives the QI an irrevocable direction to pay the exchange funds to an assignment company, and the exchange agreement's amended to provide for an agreed-upon payment stream. Exactly what we've been talking about in the structured sale, except the QI is now the buyer, the exchanger is the seller. And upon the terminating event, whatever it is, day 45, day 180, or the boot, the QI then transfers the exchange funds to the assignment company, uses the money to purchase the funding agreement. Just like we showed, life insurance company then makes those future payments. And this is the schematic for it, exactly what we've seen 2 or 3 times already. Seller, buyer, now it's exchanger QI, signs the future obligation that is set up under the amendment to the exchange agreement. buys the funding agreement to cash, they make the future periodic payments. Okay, what about the legal foundation of this? And we'll be able to go through this pretty quickly, actually. We would take a look at the legal foundation of structured sales. So everything that I've already talked about, and then layer a couple of things on, because now instead of the seller being the seller is the exchanger being the seller, and the QI is the buyer, so to speak. Or the transfer, better terminology would be transferor and transferee. So to qualify for 453 purposes, a property has to be disposed of and then periodic payments received. Well, in an exchange, it's disposed of through the exchange to the QI. In '94, the J-regs were finalized, and I'm sure you're all familiar with those. And this was with Treasury Decision 8535, which coordinates the rules between 453, or the regs under 453, and 1031. But basically, if the cashier, well, these are the kind of the brief rules of the coordination. But two things that are important is that the QI is treated as a QI even though there's a failure to ultimately acquire identified replacement property, or better yet, to finish the loop, to finish the exchange. But the effect of the J-regs is to allow a taxpayer exchange to report as an installment obligation the obligation of the QI to transfer the money to the taxpayer under 453. And you can read those. But two other very important things is that the relinquished property still has to be held for productive use in trade or business or for investment, so it has to be a valid exchange. And also, there has to be a bona fide intent to enter into an exchange at the beginning of the exchange period, which there is with what we're talking about. So then, here the J-regs anyhow provide this special rule, commonly known as the buyer note rule, and it provides that for purposes of 453 in the regs, that the receipt by the taxpayer of an evidence of indebtedness of the QI's transferee is treated as the receipt of an evidence of indebtedness of the person acquiring the relinquished property. Okay, the preambles to the proposed and final regs make it clear that for purposes of 453, and that's what's determinative here is 453, because we're qualifying for installment treatment, that the QI is the transferee of the relinquished property. That's what we're arguing. So you can see the language here, but this is the site, and what it says is this works because the qualified intermediary's transferee is not the person who acquired the property from the taxpayer. The qualified intermediary is treated as that person. And to take it a step further, then the preamble to 8535 says this with respect to the buyer note rule, that even though these regulations generally treat the qualified intermediary as having acquired and transferred the relinquished property for other purposes, but establishing that the QI is the transferee. Now, this PLR that we just talked about, I just wanted to put a quick slide in here, is that, like the employer in that the intermediary assigns its obligation to make the future payments, and based on the services analysis in the PLR, neither the assignment by the intermediary of its obligation nor the assignment company's purchase of the funding agreement should be viewed as conferring any sort of constructive receipt on the taxpayer. And constructive receipt's not applicable here because the taxpayer doesn't have a right to receive the payments before the time that's fixed in the exchange agreements. In other words, it's a valid note. I'm going to turn it over at this point to Joe. To Chris.
Thanks, Brian. Appreciate that. Obviously a technical discussion, but really the bottom line is all of you just heard why a structured sale legally works and why the fallback works. So Brian, thank you for that. I'm going to call in my colleague, Joe. Are you with us?
Can you hear me?
We can hear you. Welcome.
Isn't that a great thing?
Welcome, Joe. Yeah, so anyways, Joe, I'm going to go ahead and I'm going to get out of this real quick, Joe, and tee it up for you. But Joe's our CFO, as mentioned, and Joe's going to go through a spreadsheet and a client deliverable that he's done an excellent job of creating. And I'm going to get to that right now. And no one make fun of my desktop. There is method to the madness. But very briefly, I'm going to be pulling up our client questionnaire just to kind of set up what Joe is going to be discussing here. This is the information that we will gather from you and your client, and usually their advisor or their CPA or tax professional, in order to provide the best consult for their independent situation. And again, I know many of you have seen this questionnaire and have already used it. But with this information gathered, Joe and Brian and team will provide the client deliverable, which is the actual numbers. So with that said, Joe, please take it away.
Thanks again, Chris, and thanks for everyone for joining. When we talk about installment sale treatment, we talk about deferring payment of taxes, I think everyone has either read articles or just intuitively sort of grasps and understands that, you know, paying anything 10 years from now is better than paying it today. Understands directionally that that's better. Now, what does that mean in sort of firm dollars or in percentages in terms of return on investment? What does that mean to a taxpayer? And that's what we try to get to, as opposed to just saying, well, it's a good thing. Let's talk about some numbers. And in order to talk numbers, we need to gather some information. We have to have some basis for our conclusions. And that's what we get to when we look at the questionnaire. We ask for things, obviously details about the transaction, but then we also need to understand the taxpayer's tax and financial position. Because obviously there are different tax rates based on different incomes, and not all incomes are the same in terms of their allocation between earnings, rental income, passive income, all kinds of things like that. And so we take all those things into account in trying to conclude what we believe the power of the deferral is, and then to also communicate that information to your client and our client, the taxpayer. So we take a look at a particular example here. We have calculated a spreadsheet with this massive, that goes out 40 years, month by month, taking into account the cash flows for each month of a transaction. So we go out 40 years, and depending on how the taxpayer wants to take their money, we can calculate, different results. In this example, you'll see some blue shaded areas. You'll see a lot of information. Let's just focus on the blue shaded areas for now. Those are the basic assumptions that relate, that we kind of boil down the information that we get from the questionnaire and talking with you and talking with the client, talking with their CPA, potentially their financial advisor. And we take into account the return of basis, capital gain, Section 1250 gain, which I think you're aware of, possibly any ordinary income, and then their tax rates. In this particular example, we put them all, we put them in the blue shaded areas here. Those are the assumptions that we're working from. In this particular example, a taxpayer purchased a piece of property at some point in the past for $2 million and depreciated it down from $2 million to $200,000. So he has a basis remaining of $200,000 in the property. He sells that property for $3 million, and that $3 million is then broken down. Obviously, $200,000 is a return of basis. The next item is a Section 1250 gain. We skip a line there. 1250 gain of $1.8 million. That's the recapture of his depreciation. And the third item is capital gain, long-term capital gain of $1 million in this case. Then we take a look at his federal ordinary income tax rate, long-term capital gains rate of 15%, and then I'm going to skip a line and go to the federal Section 1250 tax rate of 25%, and then we've got state capital gains rate, state ordinary income rate. In this particular state, it's 6.5%, which is a little bit above average, but kind of in the ballpark. There's one line in here, though, that is something that not a lot of people contemplate and think of. It's the federal effective rate add-on. And what this is the impact of including a large capital gain in a taxpayer's tax return. Once the adjusted gross income, let me just step back. The adjusted gross income of a taxpayer is the number that the IRS tends to determine whether or not a taxpayer is I'll just call it a lucky rich guy who should be taxed more heavily, or if he's not. And although capital gains are taxed at preferential rates, capital gains serve to increase a taxpayer's adjusted gross income and therefore subject them to sort of penalties, let's just call them. And those penalties are obviously AMT, phase-outs of itemized deductions, phase-outs of personal exemptions, and things like that. So those all serve by way of reducing deductions, subjecting to AMT. Those all serve to increase tax, even though everyone thinks, well, capital gains are all taxed at 15%. Well, they're not. And in this case, it's adding 3% to the taxpayer's effective tax rate. And so if we take a look at the closing column in a taxable sale, and you'll see that the taxpayer will pay $866,000 in total tax. Okay, if he just takes his cash, his $3 million, and then he goes to CPA or does his taxes, he comes up with a total tax bill of $866,000. That leaves him with $2,134,000. All right, and he can do with that money what he wants. If he invests it, though, we're going to take a look at what he would need to earn on that $2.1 million to match the way that a structure will behave. So we go down and take a look. Let's compare now to a structured sale. If we go down below, and obviously the taxpayer puts $3 million in this case, all of it into the structured sale. His tax bill is zero because he's received none of the proceeds. His tax savings is $866,000. Now, $866,000 as a percentage of his after-tax investable cash of $2,134,000 is 40.58%. So that's one of the metrics we calculate. How much more money do you have working for you if you enter into a structure? In this case, it's 40.5%. Very good number. Anything in double digits is good. 40% is exceptional. So now we go back up to the top and take a look at the institutional funding agreement earnings rate. That's the small yellow number there. That number is 5.29%. That's the number that the internal rate of return that we're given from Allstate in this case on the payment stream that the taxpayer will receive in the structured sale. That's going to earn 5.29%. All right. Now, when we take into account the deferred payment of taxes over time, what the taxpayer would need to earn on the $2,134,000 in a purely straight cash taxable sale is what we calculate. That number is 8.73%. Okay, so even though the taxpayer is earning 5.29%, which is a very good rate, it's a conservative rate, but it's a very good rate on conservative money, when you take into account the fact that he's got an additional 40% at work for him and then paying the tax, that works out to an 8.73% return required to match the structured sale. That's the number we try to come up with to put in front of the taxpayer to say, look, if you can make 8.73% on your taxable sale after tax cash of $2,134,000. If you can make more 8.73% or more day after day, month after month, year after year for the next 10 years or 20 years or however long you plan to have your cash in a structure, then you should do it. And if you can't, and by the way, if you can do it with the same risk characteristics of an Allstate annuity, you should do it. If you can't, then you should do a structure. And that's the mathematical analysis that we come up with. Obviously, there's a lot that goes into this, and so your help in gathering the information is appreciated. And I guess at this point I'm probably a little bit out of time, but it's a very powerful tool and very helpful in our explanation and very thorough. So with that, Chris, I'll hand it back to you, and I guess we can address questions if they come in.
Yeah, absolutely. Thanks, Joe. And Joe's done a great job with this spreadsheet. It really breaks it down to the exact number of what they need to find. So excellent work there, Joe. And if everyone could just give us maybe another 5 minutes here, I promise to wrap it up pretty quick. Let's see here. Actually, we had a few. We actually have a number of questions that came in. I'll tell you what. Let's run through the rest of this, and then you folks that want to stay on, I will go ahead and address all the questions afterwards. So thank you. So let's get right to the opportunity page here. You've heard the justification of why it works. You've seen what the client deliverables are that we present after working with you and the client and their advisors. So where can we start working together? Where's the opportunities lie? As mentioned, that Brian had mentioned, in an exchange where the exchanger is either failing to ID, they fail to close at any time, and I think Brian had mentioned this, but the amendment for the exchange document can be added at any time as long as it's before the failure date. Or it's not an all-or-nothing situation like an exchange where if they aren't able to match a sales price and they're going to have a napkin rule issue, we can use as one client calls it, the quote-unquote scraps. And point D, I'm sure a lot of you will run into where clients in an exchange, and for whatever reason, things happen and they want to get out of the class of real estate for their investment, but they're still looking for deferral options. That's something that we can work with. And I just put in here land. We work with a lot of farmers and a lot of landowners that want to turn their investment into some cash flow, aren't very comfortable with what's built on top of the land, the bricks and mortar, and so this is a great strategy for them. Going forward, we also work in a failed reverse exchange for the same reasons we work in a forwarded exchange. As mentioned earlier, non-exchangeable assets. We've worked with clients on personal residences over the 121 exemption. So the 250 or 500, depending if you're single or married, over that, we can structure vacation homes or second homes where an exchange isn't going to be applicable. And we've done a lot of work with Goodwill, the sale of a business. This has gotten a lot of attention lately. For those folks that are still lucky enough getting large bonuses and the large commission checks, that is all ordinary income, taxed from penny one. And we worked with a lot of the brokers, the dealers, and this is a good opportunity for all of you to speak with your channel, or if you're the person that's going to be getting the commission, to take some of that and put this into a structure. And a lot of folks are using this to really plan out their retirement. So it's been a great strategy for point number 4 there. As mentioned earlier, and this is something that one of our partners had uncovered, and we researched and got guidance on this. But as Brian had mentioned earlier, where there's an early payoff on a note, where the original buyer sells the property, which leaves the original seller with potentially a situation that they don't want to be in. So we can go ahead and structure the remaining note, and then they don't have to worry about that early payoff or any of the other complications with a traditional installment sale. So, and a lot of the folks here on the phone that I've talked to had said, I wish we knew this 6 months ago, because we or one of our clients was going through this. So it's a great opportunity for us to run the numbers that Joe has just gone through to see if it's a fit for point number 5 here. And number 6, we've been seeing a lot of this. We call it strip the gain, but we run into a lot of clients where they still have maybe a significant amount of debt on the property, and the debt is going to be boot if we get into the situation after the closing. So what will happen is we'll get involved with the client, run these numbers, and in fact they can go ahead and possibly match their base, match their debt into an exchangeable property, something that they can ID and close on fairly quickly, and then take the remaining gain, whatever that may be, and structure that. So now they've not only matched their debt situation, they were able to take advantage of 1031 as well as 453. A little bit more of a complex scenario, but as long as we get in early enough, it's something that has been attractive to a lot of our and your clients. So with that said, I'm running through this, and I will be done here in another 2 minutes, and we appreciate everyone holding tight. And in order to kick this off, we wanted to, and this is the end of the CES portion, we wanted to kick this off and make an offer here, and we're going to have a little fun with the mid-year of FEA coming up in the middle of May in San Diego. And so with that said, now whether you look at him as a preacher or as a Oprah couch ruiner, whatever the case may be, I think we all agree he is the original Top Gun. But this is something that we have done with our partners across the country, and 100% each event that we have had and have done this process, it's been successful. And so we're going to make the offer that those of you on the phone, those folks, and I know most of the folks here are on the intermediary side, but this goes for any of our partners. Those are the folks that decided to get into a partnership with us previous to FEA. We're going to roll this out for you. So what is this Top Gun lunch? And again, this has been very successful, and it works. So what is this? The bottom line is it's a luncheon where you will gather your top guns, one from each industry, so there will be no competitors. So in other words, you would invite your main attorney that you work with in real estate or estate planning or both, a CPA or tax advisor, a commercial broker, a residential broker, maybe some of your mortgage folks. Get them into a room, and maybe there's 12 to 15 of them. And again, it's one of each, so there's no competitive situations. What will happen then is we'll do a lunch. And again, the offer is for the new partners that are working with us before FEA in May, that we will go ahead and sponsor and pay for that lunch. During that lunch, each person in the room will go out around and give a 2 to 3 minute explanation of what they do and what a good client for them is. And so there's a networking element to it where everyone gets to know each other, and you're putting folks together that might be able to work together. So it's a great networking opportunity. You can give a little explanation or presentation on things that are going on new in the 1031 world. So it's a great way for you to touch your folks and give them an opportunity to meet new people. And then we'll give a little discussion on the fallback and structured sales. And it usually goes for an hour and a half. So it's a great way, again, to touch your folks, kind of a unique concept where not only are you presenting to them, but you're connecting some dots and having them meet new people. And this has by far over the last 2 years been our most successful event that we bring to our partners because it's a win-win for everyone. And as mentioned, the folks that are on the phone here, and we decided to do a partnership together before FEA. The Top Gun lunch doesn't have to happen before the FEA, but as long as we get a partnership involved, we are willing to, I'll come out and visit with you, and if you have multiple offices, you decide the office to do this at, and give a nice little lunch like this, and we will we'll pick up the tab. So with that said, we do thank everyone, and I will go ahead and answer some of these questions that came through. It looks like everyone's staying on board. So again, I apologize for running a few minutes late here. We appreciate that. Okay. Okay, we've got 2 questions that are, let's see, off the top here. Does this require an ID? Does this require? Oh, good, okay, good point. No. So this does not require an ID. So if you have a client or you're working with a client and maybe they're not looking to do the exchange or they may want to get out of it, most of the folks on the phone here want to, of course, keep them for the full 180, either for the opportunity to try to sell them an exchange property, or if you're an intermediary, of course, to have them stay the full 180. This does not require an ID, so I would encourage them go out and ID all the way up to 3 or whichever rule they're going to use. And then this is absolutely a fallback. The only thing we need to do is be involved previous to the failure date to amend the exchange agreement. So this does not require an ID, and sometimes we'll refer to this as the quote-unquote quote fourth ID. So great question. Thank you. Next question is, what do we charge? At this point, we do not charge anything. The only way that we get paid, and then we do our commission share with you, is through Allstate when we close business. But at this point, for all the work that Joe and Brian do with the consult, sitting with the client, providing those numbers, that at this point is still all free of charge. So if the client decides not to do this, we do not make any funds. So at this point, it's a free service to see if it makes sense for them to structure their proceeds. So we appreciate the questions. Let's see. Okay, it looks like we've actually had some very technical questions here. Let's see. Here's another good one. Can the future payments be assigned to another party? They can. That's a great question. That is going to depend on the person that's exchanging or the entity exchanging. It just needs to be legally clarified who's going to be receiving the payments before the closing date. So if they're not in an exchange and it's just a traditional structured sale, before that closing, and if it's in an exchange, of course, then before the structure is set, which would have to be before that failure date. So good question on that. Let's see the next one here. Okay. Estate planning. What happens if the person in the structure passes away? Good question. What would happen is the remaining payments will roll into the person's estate, and they can't be changed. So however it's structured, then however the estate dictates those payments to be made to the heirs, whoever that may be, that is exactly the way that the heirs will continue to receive the payments. So if there are payments still left in the structure, it'll roll to the estate, and then however the estate dictates the heirs to receive those payments is how that will be structured. So good question on that. Okay, we have a comment that they liked the Top Gun picture. I appreciate that. Let's see, and it looks like the rest of these are fairly technical number questions. And I see those folks that ask those questions are still on the phone. For a matter of time and not confusing too many of these folks, we will go ahead and answer those questions, put this in a summary, because this is going to require some feedback, and we'll send out a summary page to all the folks that were on the phone here to make sure those get answered. And, of course, then anyone that has any questions can call us direct. And there's my information. So with that said, again, we sure do appreciate. We had a great crowd. It looks like most of the folks stayed on. Here is my information. And those folks that we are still working with, we appreciate the business. And those new folks, we look forward to working with you. And, again, we encourage you to take us up on the offer of Top Gun lunch, and we can get into more detail if you like. To discuss that. So anyways, we appreciate everyone being on the call today. And again, we look forward to working with all of you in the very near future. Take care and have a great day.